Wayne, it's great to see you today. Give me a sense of how the disaster response is coming in from the fires.
Well, I'll tell you, it's a very, very tough situation out here, Contessa. We've got folks on the ground. We came out on Sunday and Monday, 2 different locations where we've got places where our members can come and see us. We've got our large loss adjusters that are out in the field as we can get back into areas as well. But most importantly right now, we're also doing aerial imagery, which has allowed us to see some of the zones you can't get back into. And we've actually settled many of those claims already because of the aerial imagery and the ability to streamline that, make the checks payable, and get that into the hands of our members.
Now, what happens when we talk about inflation and how much construction materials and labor have gone up, that what your clients may have anticipated the house was worth a couple years ago, or what USAA thought it was worth a couple years ago, and what it is worth now because of the cost of rebuilding has gone up? How do you handle that gap?
Well, first of all, we're working every renewal to make sure we've got that coverage to the right level. And then many of our members here in California actually have an additional capability in their policy that should the rebuilding cost be higher than the total cost in the policy, we'll actually cover that up to an amount as well.
The moratorium that was declared from the state commissioner on insurance says no insurance company can go forward with non-renewals right now. I mean, they can't cancel policies. Does that matter to the business of doing insurance? Is that something that gives you hope for the future of the insurance market in California? What does it tell you?
Well, here's what I'll say from a USAA perspective. Unlike many other members in the industry, we actually don't non-renew our members because of fire risk. So we're very purposeful about with our military members to be able to continue to serve them. So this idea of non-renewals has not been, an issue for us.
But how can you afford that? I mean, if we saw what living in risky parts of California mean, how can you afford not to factor that in?
Well, we continue, as we've mentioned before, to lose money on homeowners in California, and this is part of the reforms that have to come even greater here in California to get the pricing where it needs to be, to get all the capabilities to be able to assess future risk and price appropriately, so we do have a sustainable market. One of the elements that has to change in this market out here.
Okay, so what do you need as an insurance company from the state of California, from the insurance commissioner, from the legislators? What does this state need to have a healthy insurance market?
We need to continue with the reforms that were put in to streamline the process for putting new rates in. We need to be able to use all the data and analytics about future risk and be able to bring that into rates. And we need to be able to move at a much faster pace and then have the ability to price appropriately. So this year, probably a 7% increase in our California homeowners rates. We've put in for another 20%, but we're still not rate adequate, and we're going to have more flexibility from the commissioner in order to make that work.
2 more questions for you. Does it matter to you in terms of your reinsurance kicking in, whether the Palisades fire is combined with the Eaton fire into one event, or whether those are considered separate events?
Yes, it matters a lot, and whether you have catastrophe bonds, traditional reinsurance, individual treaties out there, there's a lot of technical changes and issues about how these events are scheduled and then how that impacts reinsurance treaties with every carrier, including us, and with different parts of our reinsurance treaties as well. It's a very complex situation.
If the FAIR plan cannot afford to pay out on the claims that are coming in, that then rolls over to other insurers. How do you factor in the potential for the FAIR plan not to be sustainable?
Well, that's an open question right now. I think everyone is debating about the solvency of the FAIR plan. We know assessments are coming. The question about how those can be passed along is still an open question as well. And this too is one of the challenges that's going to have to be solved in California in order to have carriers want to stay and continue to grow their market here.
And the last one, I know the investigations are still continuing, but if it turns out that a utility is responsible and or negligent and bears the responsibility for starting this fire, what does that mean for you in terms of being able to recoup losses?
Well, if you go back to Northern California and PG&E, I think that's a great case study of how the insurance industry and consumers came together to address accountability and then apportion benefits out to the community as well as back to insurers, and then came back to their policyholders and reinsurers as well. And I would expect this situation will be similar, but again, a long tail on managing through that event.
I know you've got a big job in front of you today and a lot of team members who are eager to talk to you and hear from you. Thank you for spending a few minutes with me.
Well, thank you. Thanks for being out here, and just for all of our members here in Los Angeles and everyone in Los Angeles, our thoughts and prayers are with everyone. This is a tough rebuild as well. I think the work has just begun, getting money in people's hands, but getting them back, in their homes or into their next home. That's the next challenge that's going to be very, very difficult.
Wayne Peacock, thank you.
Thanks, Contessa.